Good day, good afternoon, and good evening to all of you tuning in to this Reuters Events webinar. My name is Marek Razuk. I lead all of our research on the investment side of Reuters Events. This webinar is the third installment of our series leading up to our investment summit on December 3rd and 4th. We've had over 1,000 people register for this meeting, and a big hello to all of you joining us live today, and also to those watching on demand. For those watching live, this webinar is being recorded, and having said that, you can ask questions using the Q&A tab, and I'd encourage you to do so. First, I wanted to say hello to our two distinguished speakers, Stephanie Link and Shannon Saccocia. Hi, Stephanie. Hi, Shannon. Thanks again for being with us.
Our pleasure.
Stephanie is the Chief Investment Strategist and Portfolio Manager at Hightower Advisors, who manage north of $50 billion. And I just wanted to congratulate you on the new role, Stephanie.
Thank you very much. It's exciting.
And you'll tell us all about that in a second. Shannon serves as the Chief Investment Officer for Boston Private, a leading provider of fully integrated wealth management, trust, and private and commercial banking services. So before we start, I'll ask both of you to introduce yourselves further if possible. Stephanie, if you'd like to go first.
Sure. Well, this is so exciting to be part of this this webinar. I think it's going to be a wonderful discussion. Shannon is one of my favorites on TV, and in terms of as an investor as well. I think we think very similarly. So it may be all one side at this point in our discussion, but you know, there's we also have healthy debates and that sort of thing. So I'm in the investment world for over 27 years. I started on the institutional sales side for 16 years. I was an institutional salesperson, and then I ran the New York sales desk, and then I was the director of research. I then wanted to switch over to the buy side, and had Jim Cramer and I had a mutual friend, and Jim was looking for someone to run his charitable trust and to get me to the buy side. His charitable trust is only about $4 million, but it has 75,000 subscribers that join in. And so it is very visible, as you would imagine, as Jim is very visible in general, but learned how to run money. And it's quite different to go from the sell side where you're marketing analysts and you're marketing your ideas to actually putting your money where your mouth is. So I worked with him for 7 years. And along the way, I became a CNBC contributor as well. And then TIAA was looking for someone to be the face of the firm and also to run money and to be a leader at the company. And so I left to go to work for them. Worked for them for 5 years. I ran a US large cap core portfolio. It was just under $4 billion. And then came January, and I thought, the buy side is under secular decline. The sell side is under secular decline. I want to find a place in this industry that's actually seeing growth. And I literally linked into the CEO of Hightower and said, could there be a fit here? And he linked in right back, and we had a really nice discussion about what we could do at Hightower to A, increase the visibility, but B, also to gain assets. And I do think that there are very favorable demographics in the independent wealth management space. And so I was very attracted to that. I still run money, so I have my own portfolio. So I'm going to be working with the advisors as well as continuing to be a CNBC contributor. And that's it.
Sounds great. Shannon, you want to introduce yourself?
Absolutely. First and foremost, to have Stephanie as a competitor here in the independent wealth space is certainly a challenge, but we welcome her to our side of the world here. So I started my career at State Street. I spent about 7 years on the institutional side in a consultant role. And really, similar to Stephanie, I took a step back and said, I'd really like to be more intimately involved with the end clients. And so I started at a very small RIA that was sub $1 billion. I think I was employee number 11. And that was 16 years ago. So at this juncture, you know, we are, as Marek mentioned, we are a integrated wealth management firm. We offer sophisticated financial solutions across a myriad of different products. Our investment team both manages money in-house for US stocks and US bonds, but we also couple with many outside management firms, some of the best in the business, to be able to provide those complicated solutions for our clients. And so I'm very excited to be here, having done a little bit of everything from managing equity portfolios to fixed income trading, manager search selection and due diligence. And then previous to being the CIO, I was actually the chief investment strategist here at Boston Private as well. So I'm very excited to talk about a number of different topics and excited to see where we can go with this particular conversation.
Fantastic. It's so good to have you both with us today. And I wanted to start with yesterday's news. That was some news. Kamala Harris, after much wait, was finally revealed as Joe Biden's VP pick. I wanted to get your initial reactions. So Shannon, you first perhaps. I saw you tweeted about futures rising on this news yesterday. And if I'm not mistaken, they're on the rise again today. Can you tell us what you think this means for investors?
Sure. I know we're going to spend a lot of time talking about, and hopefully we're driving home some level of optimism about trying to look forward and really not place too much reliance on investments or elections for investment decisions. However, I think when you look at the candidates that were potentially, slotted for a vice presidential nod, there were concerns, I think, from Wall Street really that this would be a more progressive pick. And so for, particularly with Senator Elizabeth Warren being in the mix. And so I think if you look at it in terms of, what the outcome will be of a Biden-Harris ticket, I think this is probably the most moderate outcome that you could have gotten based on sort of the primary candidates. And so from a Wall Street perspective, I think this was sort of the known entity. There's no real surprise here. And I think that if you go back even 6 months or so, that Wall Street had sort of looked at this as the ticket that they would have potentially expected. And so with anything related to elections, it's all about uncertainty. And so I think this is the more certain outcome as far as the ticket itself. Now, what the platform looks like, we certainly don't have all of those details. And I know we're going to talk about that a little bit, but I think this was, there were no surprises here as it relates to what Biden and Harris have talked about as part of the campaign. And so there offers a little bit more transparency than maybe some of the other contenders that we really didn't know where they sat from an economic perspective in their platform.
Thank you. And Stephanie, your thoughts on Kamala Harris's nomination and what it means for markets?
And I'm not shocked that Shannon and I actually agree 100% exactly what she just said. I would simply say she's likable, right? I think the problem with Hillary Clinton and why she lost last election was she wasn't as likable. I mean, certainly certain groups did like her, but I think Harris has a very genuine type of personality. Whether you agree with her politics is a totally different story, but I just think when I see her, she's approachable. I can understand her. She keeps things simple. She's determined. She's got great energy. And I think she's a wonderful choice to Biden, who is 77, looking for a presidential ready. She's 55. I think she's presidential ready. I think it will take some time for sure. You always have to learn in a new job. I'm learning that myself 4 weeks in. But she's got a minority background. So that should help Biden as well. And of course, I think she's a little more left than Biden, but certainly, as Shannon said, not as threatening, if you will, for the market's point of view as a Warren or a Bernie Sanders, right? I mean, that was certainly something that the markets were trying to get their hands around. So she's moderate, but definitely a little more left of Biden. And I think she's going to be very aggressive on tax. She's known for her LIFT Act, if you will, which is giving tax credits to the low and middle income families and people, and taxing the wealthy, right? So this is very consistent with what Joe Biden has outlined. And again, as Shannon pointed out, we don't really have all the details just yet, but we do know that likely taxes are going higher. This is very consistent. So the pick is very much what we had expected. It's kind of right down the middle of the fairway if you're a golfer. And I think, though, that it's a nice energy boost for Joe Biden for sure. And we'll have to see. I think on the healthcare side, I wonder, does she go public option? Does she go Medicare for all? Because she kind of switched a little bit. So I think we're going to have to really listen to see and to hear what both are saying. But at the end of the day, people do vote for the president and not the vice president. So this is something that was good for Biden, kind of keeps the momentum going. As we know, he has a 7-point lead according to certain polls. 7 to 10 points. We'll see. We have a long way to go, but I do think that this is a good news event, and I think Shannon's right. I think that's why the market has actually rallied.
Thank you. Thank you. And sort of on that note, right? What political party platform issues should investors be most interested in or concerned about as we move towards November? Shannon, you want to go first on this one?
Sure. Actually, why doesn't Steph go first on this, and then we'll switch off who gets to go first, so that we don't talk over each other too much.
So that you could agree with me, and then we could go
right.
back.
Right.
Sure. I would say, look, there are 3 outcomes. There's status quo, there's blue wave, and then there's Biden winning with a mixed Congress, right? And I think status quo looks a little iffy at this point, right? Because we do know the polls, the numbers, as I mentioned, Biden looks like he is leading by 7 to 10 points, and the poll numbers for Trump are running at about 43%. So there's a lot of question marks about how he handled COVID, how he's handling these protests. At the same time, there's an enormous amount of liquidity, and Shannon and I talk about this all the time on CNBC. There's so much liquidity in the system, fiscal, monetary policy. We're going to get more. I know that Congress is debating and discussing right now, and it sounds like they're really, they're not even close to the finish line. That's the way Congress works. We know that. So I'm hearing something gets done maybe more like in September for the next fiscal policy, right? And it's going to be to the tune of 1 to 2 trillion. The question, and why I bring it up, is will this help the economy and the momentum that we have been seeing, the recovery that we have been seeing here in the United States? Because if that's the case, people will feel better about the environment, maybe perhaps their jobs a little bit more secure, and perhaps maybe that's when Trump gets more support. We have a Republican basket of stocks and we have a Democratic basket of stocks, and believe it or not, since July, the Republican basket of stocks have started to outperform the Democratic basket. So that's starting to tell you there's a little bit of a maybe small momentum shift going on. Certainly, again, too early to really call it. So, but that's my number one, status quo. We don't really know if it's going to happen, but that's your option. Your next option is blue wave, and that's a Dem sweep. And that certainly would be something that I think maybe might spook the markets, by the way. I think you might see a bit of a sell-off initially, because then you're going to get a lot more policy that gets done, right? I mean, if you have a mixed Congress, it's so hard. And we see that that's what's happening with President Trump and the administration that's happening now, because you have a mixed Congress. It's very hard to get things done. So I think that one might spook the markets a little bit. I do think it would be a buying opportunity. And I'll tell you, because I think his tax policies that he's talking about, while they will hurt earnings, S&P earnings by about 8 to 10%, if we go by the numbers that he's actually thrown out there, I don't know if he's going to be able to get anything done until 2022 because of COVID and all the things that are happening. And we're at a fragile state, right? So I think that's what your buying opportunity if we get blue wave. And then, of course, I think the best outcome would be Biden with a mixed Congress, because then I don't think anything gets done. And I think the markets would actually like that. And in the meantime, if nothing gets done, you still have Trump and his policies in place in terms of taxes, right? And you have regulation likely not to get rolled back. So we can go into stocks and sectors and that sort of thing if you'd like. But that's kind of my big picture. I give it like a 30% chance status quo wins out. I give it like a 40%, 45% chance that blue wave happens, and then the rest.
Technical difficulties, I believe.
Yes. So I'll jump in there.
Great.
So I absolutely agree with Stephanie. I think one of the things that is important to note is that, that inflection point about the recovering economy, because that's really important, because number one, a recovering economy does provide some lift for the current administration. If you go back and if you plot economic growth and stock market returns for each president, you'll notice that it doesn't have anything to do with the party. It has to do, with where those two intersect. And so I think the most important thing to think about is that if we do have sort of a muddling along economic recovery, and we see a couple of what I would say trend declines in this improvement that we've seen, and Biden is to get elected, I think the market gets less worried about that, to Stephanie's point, because he's not going to be able to cut or to raise the corporate tax rate in that environment, because that would be a disincentive for companies to be hiring and putting forth CapEx into the economy. I think if we get an improving economy, I think that, and Biden is to win, then he has a little bit more cover for that. And I think the tax plans, on wealthy individuals, if you look at the, Biden taxes versus the Trump tax plan currently, I think that it is very much skewed towards, taxing wealthy individuals rather than the working class and the middle class. And so I think the markets from a Wall Street perspective, how does that affect things like capital gains? How does that affect the investment environment? Those are, meaningfully important, but they're not as important as that immediate impact on earnings that a corporate tax hike would create. And so, I think this muddle through economic scenario probably supports Biden in general from a market perspective. We get a really sharp inflection here and some acceleration in economic growth, and you see Biden come into office, those taxes are going to come a lot faster. And so I think it's important to note, but I do think Congress is really the tipping point here and the most important thing. We've actually been saying this for several months, and that looking at the makeup of Congress probably is what matters the most in the next 4 years, absent trade policy, which is another question we could talk about in a second. But I think, watching some of these important Senate races in particular, I think that's where people should be spending their time if they really want to watch the polls, because that's going to have a greater impact on what happens here in the economy over the next 4 years than I think the White House does.
Shannon, what's interesting is, and I'm sure you've seen these stats too, a Democratic president on average will yield almost 8% growth in the market per year, and a Republican president will average about 3.3% on average to the market, to the Dow Jones Industrial, not the S&P. But if you have a sweep of Dems, that number falls to 3% per year. And if you have a sweep of Republicans, that's 7%. So really, to your point exactly, it's all about Congress and what they can get done and what they can accomplish. And so that's why it's going to be very interesting. And I think you've got to look at Pennsylvania, you've got to look at Michigan, you've got to look at Wisconsin. Pennsylvania has 20 electoral votes, Michigan 16, Wisconsin 10. And then, of course, there's important Florida as well. There's a lot of important states, but those three at the top, I think, are the ones you really have to focus on. And what's interesting today, so now we'll see what Harris and her and how she changes in terms of her policies, but she was talking about eliminating fracking, right, in the energy industry. Do you think that people in Pennsylvania really want that? So that's why I say, just keep an eye on some of these states and what the policy is that they're talking about, and whether they maybe just change a little bit, because we know that the elections are going to be decided, but just by these handful of states.
Thank you, Stephanie. Shannon, is there anything you wanted to add on that topic?
No, I don't think so, but it's a great point. We even saw Senator Warren kind of pull back on her fracking day one, even in the middle of the primary campaign. So I think it bears worth watching, particularly for some of these swing states. And, Biden probably had California in hand. So, that was another reason that Harris maybe wasn't, as strategic a pick from a electoral college perspective. But, so that's, he's not going to get an easy win now in one of these swing states that went to President Trump in 2016.
Right. Thank you. Before we move on to trade, I wanted to ask, are there specific asset classes or sectors that should be targeted or avoided based on the victor?
Yeah, Steph, you want to start there, and then I'll jump in.
Sure. Okay, so
I want to take trade, so I'm
you do trade. I'll do sectors. This is why we ham and egg it so well on TV, because I'll do one, she'll do the other. Okay, so the three buckets that I was talking about, the status quo, blue wave, and then Biden plus kind of a mixed Congress. Let me go through. Status quo would be positive for small companies, would be positive for traditional energy, financials, technology, and defense contractors. It would not be great, and then Shannon's going to elaborate on this, on China, trade, and companies that have exposure overseas to China, like the retail industry, where they do a ton of sourcing over there, like some of the technology companies. Now, we know in the last couple of years, a lot of companies have been moving their supply chains around the world, so maybe it's not as impactful for those kinds of companies. But I do think if you have status quo, you're going to have Trump really bringing down, and the rhetoric is going to be all about China and how horrible it was their fault on COVID, and it's their fault because they're not complying to the first trade. The first piece of trade and the first stage. So I think you want to be very, very careful and very mindful about kind of the rotation that we've been seeing in the marketplace as we've seen global growth get better, and the cyclicals have done well, led by China and then Europe and then our recovery in the US. You gotta be very careful if status quo happens, because that all of a sudden is probably going to, you'll see growth actually recede, I think, and then just worry, the worry again, and the multiples contract, and that's what we saw last year, right? If you get blue wave, that's green energy, of course. That's infrastructure. I could probably make a case for infrastructure on status quo too, but certainly I think you're going to get infrastructure discussion, and then healthcare. Not big pharma, but actually services, right? So you're going to talk more like HMOs and those kinds of companies. But big pharma is on the negative list for blue wave. FANG is on the negative list because it's more regulation. And high minimum wage companies will be on the negative list because we know that they want to increase the minimum wage. So that's going to increase the costs, obviously, for those companies that are dependent on that. If you get a split, I have to tell you, I thought really long and hard about who the winners are. It's like the market, risk assets, because nothing gets done and it's kind of status quo light, right? It's like status quo 2.0 kind of thing. And I think I think that would be actually something that people would kind of just take a deep breath about. The negative would still be pharma and still be FANG, right? Because I think both sides really want to control drug costs, and I think that's going to be a headwind for that space. So I would avoid those.
Yeah, and I would agree. I think that pharma, if you go back to 2016, the summer of 2016, there were opportunities to add healthcare stocks because it was, Clinton seemed like she was going to be the victor. And there was a real sell-off in drug stocks. And so now there's really not an opportunity here. I think high drug prices are across the board an issue from, both sides of the aisle. And so there's going to be some continued pressure there. I do think, to the third scenario, which is kind of status quo 2.0, I mean, I think it's status quo with juice too. We've got, incredible monetary and fiscal stimulus behind something, and you potentially don't have the overhang of trade policy. So you look at the potential for, global retailers like Nike, like Estée Lauder, like these brands that have really kind of put their footprint in taking advantage of the, increasing middle class in China, domiciled here in the United States, but have looked at that as their next growth market, and being able to have I would say the high-end manufacturing. So while technology companies have certainly tried their very best to diversify away from their supply chains in China, particularly over the last couple of years, there hasn't really yet been the next China as it relates to high-end manufacturing, skilled manufacturing that we're not quite ready to bring back here to the United States. And so some of that is going to sit within the Chinese economy because the Chinese government wants to sees themselves as a leader globally in that space, no longer the lowest cost provider, but really the skilled provider for inputs. And so I think that I agree with you. I think that the last scenario probably gets us definitely some multiple expansion as we wait for earnings growth. But I think it's difficult at any given period to try to determine exactly what the platforms will produce. And it generally takes some time, but you'll see some trading in some of that. The only other place that I think is kind of interesting from an infrastructure perspective is just the material space. I mean, that's been a place that's really been forgotten. And if you see improvement with China relations and you see this tailwind and you see an infrastructure package, that could actually be a place where some of these true cyclical businesses actually get a bid. Does that lead to a valuation value rotation? I don't know. I'm, certainly hesitant to call for that right now. But there are going to be some opportunities to marry some of the, the mean reversion trend from growth to value and what's happening in China and what's happening here in the United States with a desperately needed infrastructure upgrade. There's definitely some thematic ideas in there that investors can apply to their portfolio.
And Shannon, and I know you know this though, for value really to be sustained, because we're seeing this rotation right now, right? And that's because you're getting a little bit better economic data around the world. But for really to be sustainable, you not only need better growth, to your point, you need a little bit of inflation, which is why today and yesterday, the PPI and the CPI were sort of kind of interesting that they came in hotter than expected on a month-over-month basis. However, year over year, it's still very tame. But those are the two things that you actually really do need, I think. You're going to get the growth. I have no doubt that you're going to see the recovery in the economy from this year to next year. I mean, the fiscal policies and the monetary policies put in place is 44% of U.S. GDP. It can't not, in a way, right? And there's a reason why they say that they say you don't fight the Fed. You don't fight the global Fed either, and you've got massive stimulus around the world. So if it does lead to better growth and eventually a little inflation, maybe that's when you get more than just this short-term trade into value. And I would argue, though, that since it's impossible to time, you want to own a barbell. You want to own like some defensive growth companies, quality secular growth. You do want to own some value. And then one last stat I wanted to just present, because I think it's sort of interesting, because you ask about, what sectors, what should we avoid, what should we buy? Believe it or not, the S&P is your tell. Right? Strategist has done some amazing work in terms of what they're watching in Washington. And they came out with a report and they said, watch 3 months ahead of the election. And if the market is up in the S&P 500, the market is up, 100% of the time the incumbent has won. Okay. And if the market, those 3 months, if it's down, the incumbent 100% of the time has actually lost. And this goes back to 1984. If you go back to 1924, it's 87% of the time these two stats work. So that's pretty big. Now, look, I know we have it's different this time because there's so much going on with COVID and it's so hard to really measure that. And, and the unrest in the country and the protests and that sort of thing. So we'll have to see. But I just think keep an eye on the S&P and see what it does 3 months ahead of time. And we'll see if it works.
Thank you. I certainly will. To move on to trade, I know Shannon, you wanted to discuss this, so I'll be asking. Yeah, please go ahead.
Sure. So I think coming into after the 2016 election, our biggest concern from an economic perspective was trade policy. I think the President Trump really ran hard on this in his platform, and we were surprised that he tried to tackle the ACA first, because it seemed like a huge disconnect for us on something that was a much harder, much more uphill battle for him to be able to affect change in. But he did, and so it gave us a little bit of time, which allowed the markets to have a really nice period before having to worry about this trade overhang. And so my challenge with trade policy with a President Trump reelection is that it's not, there have been pundits that have stated that this is a positive long-term impact for American competitiveness to, try to reset our relationship with China. And I don't disagree with that. The problem is that it hasn't been a sort of systematic process to doing that. And so it seems like we push here and then we get negative feedback from the market, or he gets negative feedback from business leaders and he takes a step back, and then he tries another way around and then he takes a step back. And so I think that the biggest challenge with a reelection is, what it is the trade policy going to be handled in a way that is better telegraphed and better understood about what the end goal is. And if the end goal is just improving American competitiveness and improving the commitment to intellectual property protections for American companies, let's figure out a plan that actually moves us towards that. Because I do think that a lot of critics are saying, globalization leads to lower costs, globalization is better for consumers. But it does make sense that if we have this intellectual capital and intellectual property production here in the United States, that we expect it to be protected in other markets. And we have that with our other trade allies. So I think the biggest concern as we think about the way President Trump talks about his reelection platform, is this just a China question? Or is it going to be this willy-nilly tit for tat with Canada and European cars? And, because at some point that really detracts from the message, when he's on message about American competitiveness in the Chinese market, I think that he can find some business leaders to help him craft the effective policy for that. He doesn't stay on message typically, but in this area, I think that's going to be really a critical piece as we look towards this reelection, because this is the overhang for many U.S. businesses, particularly large multinationals, is what should we be expecting? Is this 4 more years of we wake up on a Monday morning and suddenly there's another round of tariffs that came out of nowhere? And so I think that that's one of the most important things. And I think the American business community and those companies and those CEOs that are close to the president really need to be stepping in at this juncture and saying, we have to have a better plan for the next 4 years, because trade policy is not going away. He knows that he can unilaterally affect trade policy. He doesn't have to go through Congress. And for the president, as you saw with the number of executive orders and memoranda that he put out over the last several days, that's in his best interest to try to circumvent Congress wherever he can.
I think that uncertainty is definitely a multiple contraction, number one, for risk assets in general. Number two, it really, to your point on US corporations, it's going to hold them back from CapEx and investment spend. And you know what it's going to do? It's going to lead us right back down the path of buybacks, right? And dividend increases instead. Because what are these companies going to do with all the free cash flow that they have? Because they are generating a lot, but they're not going to be plowing it in. And as a result, then you don't get the productivity growth, you don't get the GDP growth. It really has this kind of a multiplier impact, that uncertainty. And I have thought in the last couple of weeks that the certainty from CEOs, the actions that I have been seeing on the M&A front have been very, very encouraging. I look at CEOs, and I look at CEOs just like you, listen to them. They may say something, but they may not act on it, right? But yet, you know what? It started with Warren Buffett a couple of weeks ago when he bought Dominion's pipeline assets, then Uber buying Postmates. And then last week, Siemens buying Varian for the largest healthcare deal year to date. These are big, big deals. Who knows what's going to happen to TikTok? I don't even want to go down that path at this point, but it doesn't seem like they're going to be independent. But we don't know who gets it, what happens there. But the point of it is you're starting to see activity from CEOs. And that is an important thing. And that means they're a little bit more confident, that they have a little bit more visibility. If you enter trade back into this equation, that is not going to be a good thing, because you're going to see, I think, a step back from CEOs. And that is not something that I would want to see. I would just say this: while Trump is very aggressive on trade, Biden is not as easy as you would think, right? Because he actually has a plan to bring supply chains back into the US, right? He may not do it as forcefully, and to your point, Shannon, maybe not as egregiously like Trump does, but he does have a plan. He wants companies to be doing more here in the States versus around the world. And so I don't know, I guess I worry in general about trade for both candidates, more so with Trump, less so with Biden, but Biden is no, shoo-in for, China. It's going to be a perfect relationship.
I agree. I mean, and I think we're well past at this point. Any candidate that would be coming into the White House right now cannot ignore there's been enough of a spotlight on the inequality in the trade relationship with China and the lack of protections for businesses there, that you can't just kind of put your head in the sand. Not to say that President Obama did that, but I think much more so to kind of take a hands-off approach to trade in general and say, globalization, we have these treaties, we have our friends, it's great. And so I think that any candidate coming in would have to address that. And so I agree with you. I think that, and look at what's happened from an economic perspective over the last 6 months. I mean, this crisis, this pandemic has disproportionately affected the working class. And so, kind of thinking about it in terms of, how do we bring jobs back if the services industry does not pick up? And I think it's somewhat naive to think that we're going to go back to November and December of last year from a services spend perspective, within the next 6 to 9 months. Perhaps it will happen. But I don't think all those jobs are going to come back. And you cited, the increase in the minimum wage. That's a great point. If each of those workers is actually going to cost more, I think that, a focus on what can we do to bring working class Americans back into the fold? How do we get some of that? How do we get some additional training? How do we how do we pivot our educational system to support bringing those, facilities back onshore? I think that's all going to have eventual positive impacts for the United States economy, but it's certainly going to create an overhang for, everybody from financial services to technology to energy. They've all outsourced a lot of, their, production offshore. And we've loved that from an earnings perspective, right? That falls right to the bottom line. But I do think that we need to have a reset of those expectations, probably for the next 10 or 15 years, as we look at the way that we're supporting growth and hitting that escape velocity in the United States economy, because we can't, if we're just continuing to just focus on costs and lowering costs for each individual company, we're not going to get to that point.
Thank you, Shannon.
We could go on and on and on, by the way.
Yeah, you just keep giving us questions.
Yeah, I thought you were gonna jump in there, Stephanie. But no, we can move on, because as you both mentioned, there's a lot more going on in the US than the election. I'm in the UK at the moment, so we had these big announcements yesterday that, the UK is officially in a recession, but the US has been in one for at least a month or so from an official perspective. So, considering that, how much should we be considering the election as part of our investment decisions? And is that even that relevant given everything else going on?
There's a lot going on. I'll start, and Shannon, I'm sure you can chime in too. Look, there's a lot going on, and I actually think that we tend to make a very big deal about the elections because it's every 4 years, and there's a lot that could change. And again, I think it's going to be much more important to see what happens with Congress. And if you get all Dems, you get all Republicans, it's really it's a very big shift, and you'll get an initial reaction in the markets. But it is going to be policies that they put in place that they can get passed that actually are going to determine which sectors do well, if the economy can grow. What happens with the consumer, what happens with confidence, especially business confidence, as I mentioned. If they retreat and they say, we're not going to do any investment spend because we have no idea what's going on, that's something that is certainly a setback. What I would say is, look, I think the economy has seen, and our economy in the US has seen a nice recovery. But I gotta tell you something, the Eurozone also is starting to see a quite nice recovery as well. Now look, it is off of a very low base, and I have these battles with people on TV all the time because absolutely, there's no question we got a V-shaped bounce. Is it a recovery? We got a bounce. We got May and June where we saw much better housing, much better auto, much better retail sales. In July and / beginning of August, now you're starting to see the manufacturing series do better. PMIs are now expanding again. ISM new orders are at the highest level they've seen since 2018. What I mentioned before, PPI and CPI, we got to watch that. Obviously, they're hotter than expected, but we kind of root for a little bit of inflation, right? So I think all of these things in the US means that we are on track to see a recovery. Do these reopenings and partial closures start to push pressure on the recovery that we've seen? And can we really grow like we have been off of that low base? No, of course not. And I do think you're going to see the partial closures certainly have an impact on growth. That said, I still think you're going to see something like 20% GDP growth in the third quarter. And that's obviously versus a horrific number in the second quarter. And then you normalize out, right? And as you see the better economy and the data points, you can also start to build a model in terms of profits. And so I'm ignoring 2020 in terms of profits because it's really hard to judge. I mean, we just had most of the companies in the S&P 500 report and they blew away earnings, right? I mean, something like 84% blew away earnings by 23%. So it's nuts because we had no idea where we were coming from. So I'm looking into next year. I'm looking at a recovery in the economy into next year from this year. That helps profits. I can normalize profits. And that's how I can get around kind of these valuations at this point. We could talk about sectors, we could talk about investment styles, but that's kind of where I see the US. I will tell you on the Eurozone, retail sales up double digits in Spain and Italy last week. That was crazy. German factory orders up 27% last week. That's a great number. The business confidence and outlook numbers in Germany actually improved. So you're definitely seeing a global recovery. I think you're seeing actually even a faster recovery in the Eurozone than you are here in the United States, because we're kind of starting to level off a little bit. That's why the dollar's so weak, but that's good for multinational companies. And we know that probably in the S&P 500, about 70%, if I'm not wrong, if I'm not mistaken, Shannon, it's about 70% are outside the U.S. They derive earnings outside the U.S. So you do think that I do think that the U.S. and the dollar weakness will help and also be a tailwind, as well as the fiscal and monetary policies put in place.
And I would add, I think if you think about the sentiment that has, as the sentiment of investors outside of the United States, because there's no place in the world that has more of a home country bias than we do here in the United States. And so, you know, the argument that if I buy Procter & Gamble, then I get plenty of international exposure when I could buy Unilever, which is actually an international company and trades at a discount and has essentially the same balance sheet and income statement. You know, that's, you know, I can talk that until I'm blue in the face, and I've never been all that successful in doing that. So, but what I would say is that in speaking with investors outside of the United States, where the election could make a difference is that investors outside of the United States are concerned about the U.S. political situation. And they feel like stocks, particularly stocks, large cap stocks here in the United States, are expensive based on the uncertainty from our political situation. And so I think that sentiment, that couples with some of the economic improvement that they're seeing in their own backyard and saying, wow, our, you know, investments here are more attractive because we kind of see, you know, whether it's, you know, the Eurobond situation and the fact that the European Union is actually making some coordinated fiscal steps, to just general economic improvement, to the better handling of COVID-19 and thus, you know, a lessened economic impact for them. So I think that inflection point from an election perspective could actually affect the way that investors outside of the United States view their allocations to U.S. assets. And so that could be a catalyst from a Biden election that, you know, investors from other countries view this as a more stable place, and that multiple expansion that we've seen, you know, might be better justified with a more certain political environment here. So putting myself in those shoes and just thinking about global flows of capital, I mean, you see the weakness we've seen in the dollar towards the euro. You see, you know, are those longer term trends? I'm certainly not a dollar prognosticator, and I'm not going to sit here and say that I am. There's plenty of people out there if you're interested in hearing their views. But some of that stress that we've seen has not just been about the US, it's actually been about improvement elsewhere. So that's an interesting thing that we're looking at, just that global flow of capital. And is the US the best house on the block anymore? Or are there other places that globally people are finding opportunities?
And generally, with a weak dollar, you'll see better results in the EM, which people have actually absolutely ignored, right? And I too, I mean, I look at the dollar, I try to figure it out. I don't know anybody that's ever gotten it right, quite frankly. But all I do know is that it does help more global assets versus the US assets. I would say just keep an eye on the weakness in the dollar, because it could be also inflationary. So while we're not seeing any inflation at this point in time, especially as I said, year over year, the CPI and the PPI are barely up 1% kind of thing, right? So I'm not worried so much yet, but I do look at things like copper. Copper's up 35% since March. That is a global read. I always look at copper to tell me like what's happening around the world and growth. And while I know it's really hard to get copper, and so therefore it's a little bit different of a commodity, but you have to have demand. The price of copper is not going to go up if you don't have better demand. And clearly it's telling us something, as well as it might be foreshadowing at some point down the road that inflation is going to come out. And then we'll have to see what the Fed's response is. That'll be sort of interesting, which I don't think they're going to change anytime soon, especially because 3/4 of inflation really truly is tied to wages, and we're not seeing really much wage growth at this point, right? So I think that they'll probably stand pat, but that's going to be something interesting. That could be next year's theme, where we go back to fighting what the Fed is doing on the other side, right? Like they all of a sudden change their tune because they're entitled to if the data changes, right? So there's a lot, I think, next year that it could really be much, much different than this year. Well, I would love a little bit of inflation, and I really want a lot better growth. I think you're going to get probably both. I'm not so sure it's the best thing for stocks.
That's fascinating. I don't know much about copper myself, frankly.
But put FCX in your portfolio, and then you'll have to watch copper every day of your entire life. Like,
I know, and I have it in my portfolio, and it is like,
me too.
Oh, my goodness. Right? I know.
Like, what's copper doing today?
Right, exactly right. I know. It's a tough one, but you have to have, goes back to our conversation of, you have to be diversified. You have to own a little bit of, kind of some bellwether techs, some cyclicals, some hopefully that don't give you the headaches that Freeport gives you. But
Yeah.
I think you want to definitely have a blend. And I think, because I think in the last 4 weeks, if you didn't, then you're going to be left behind. But at the same time, the first part of the year, if you didn't own the secular technology stocks, then you're going to get left behind. So you really do, it just speaks to not only diversification here within the US, but then to Shannon's point, around the world. You want to look for where fund flows are, where growth is improving on the margin. I would also argue, Europe, I always look at Europe and the companies in Europe. And there's a lot of financial services exposure into the European markets, I understand. But I always look at the margin structure, and the margins are half that of the US. And I always say, geez, that's an opportunity. But for some reason, they always stay really low because it's hard for them to cut costs, right?
Right.
It's hard for them to cut costs because it's hard to lay off people in Europe versus here in the United States. So there's a lot of dynamics with the margin story, but it always fools me, like, oh wow, this could be real great positive operating leverage if they got their margins from X to Y. But they don't really usually get it from X to Y. So it's gotta be selective.
Thank you. We'll turn to my next question, and this is, this has a little to do with how the world is looking at the United States, if you will. But our own Reuters news journalists, David Randall and April Joyner, I think a couple of weeks ago, they were writing that, according to analysts at least, investors are increasingly preparing for the risk of a contested US presidential election come the fall. Worried that, the ugly political situation, if you will create volatility across markets. So after that President Trump tweet, where he said, the election could be delayed until people can properly, securely, and safely vote, that caused as you both know, I'm sure, a knee-jerk sell-off in equities, though it reversed the next day. What are your thoughts on this sort of black swan scenario? Do you think it's a real threat? Do you think markets are treating it as a real threat?
I don't think markets are treating it as a real threat. And especially if you listen to some of the folks in Congress who say absolutely positively won't be done. I think the bigger question to ask is, how do people vote in November? How do they do it? Do they do it absentee ballots? Can they go and actually vote and get into a booth, because of COVID and that sort of thing? I do not think the markets are pricing in a contested vote result at all. So if it happens, it would be a real shock, I think. But in terms of it being delayed, I don't see any chance of it getting delayed.
No, I think they're, to Steph's point, it could be that it takes a little longer for us to get the results because, but I would imagine that if we do move to a lot of people, and I know certain states are already pushing for absentee ballots and mail-in ballots. I live here in Massachusetts. I've already had signed up for mine. So, but I think you can go back to the hanging Chad situation in the Bush-Gore election. That wasn't, I think, as contentious an environment as we have today, but it certainly created uncertainty in the markets as we waited for those recounts to happen. And so my hope is that we don't have as close an election, because then I think we will, be in a situation where perhaps there's some delayed results. But I think as far as delaying the actual election and any threat from a constitutional perspective, the threat of trying to upend the Constitution, the Republicans have put up with a lot. I agree with Steph. They are not going to support, a move of the election date or, anything that would seem to interfere with the functioning of the U.S. government. That will not, they will not put up with that. So, and to your point, the reason that might be getting more play outside of the United States is that they just see it from the political climate, from the outside looking in, and not understanding how how that would just break the framework of the way that we operate in our democracy, I think, for most people. So they probably don't understand how jarring something like that would actually be were it to happen. And so I think that's probably the difference between the perception outside of the United States and then here in the US.
Thank you for clarifying. I think that that's spot on. And I think we just answered a question that somebody asked in the Q&A, an anonymous attendee who was asking, you know, how is the market anticipating or pricing a potential institutional crisis right after the election? So I think we dealt with that. I wanted, you know, since we've got 10 minutes left, there's another question from a Rifat Mughal. Can you both see it?
Let's see.
So, yeah, Rifat says, as the economy starts to recover, if inflation increases, what would the stance of the Fed with respect to be with respect to monetary policy and specifically the interest rate? Shannon, you want to?
Yeah, Shannon, go ahead, because I actually because I actually already kind of voiced it, but I would like to, let's get Shannon's opinion.
So, you know, I think the reality is that we've been unable to sustain any inflation momentum over the course of the last decade. And so I think many of the Fed governors, you know, really who grew up in the hyperinflationary environment of the 1970s were torn because they were focused on avoiding hyperinflation. And so many things structurally have changed in the world that hyperinflation really hasn't been much of a concern. And so they look at Japan from a deflationary spiral perspective and see that as much more of a clear and present danger. And so I think with everything that's happened over the last several years, I do think that they're going to let the economy run hot. You know, I think it's actually going to be less action and more in the positioning of their outlook that we're going to see the markets react to initially. And so I think if you look at anything like the taper tantrum of 2013, you know, those things do tend to have a sharp impact when the Fed pivots its messaging. But I think it's going to be a long time before the increase in interest rates actually has an impact on businesses and starts to be in any way restrictive for businesses. Rates have to go up a lot for us to actually see that impact. I mean, even on high yield companies, you know, those companies that are probably a little bit more strapped from a balance sheet and interest coverage perspective, you know, we're not anywhere near close to that tipping point. So I think the markets will react negatively when the free money appears to be, you know, the tap seems to be turning off. But I think it's going to be a while before we actually see the real economic impact of that.
I think it really goes back to, are we going to have another round of COVID virus case increases and deaths and hospitalizations? And what happens in the winter? And oh, by the way, let's just say we do get a vaccine by 4Q. Do we have enough? Will people take them? Will they work? So, I mean, I think 1 in 3 people I talked to said they would not take the vaccine. So I think that, now that's just me and that's anecdotal, that's not scientific by any means, but my point is that there are skeptics out there. So it's not like all of a sudden you announce a vaccine and you're off to the races and we're back to normal and everyone goes back to normal. Personally, I think our lives have permanently changed. I don't think we're all going to be working home 24/7, but I do think you're going to have a combination. I think technology plays a huge role in that. That brings me back to, on the investing side of things, why you want to own secular technology companies, because their total addressable markets just went through the roof, especially those stay-at-home kinds of companies. And that's why you've had, like, you know, Zoom go crazy and Zscaler go nuts and all these companies. Now, I'm not saying that that I can justify the valuations, but I can justify total addressable markets for these companies, and it's real, and it's something that you want to have participation in, even if we do get a shift to the value rotation into next year. But again, I think a lot is going to depend. Fed policy is going to depend on what happens with COVID and what happens to our growth in the economy. And can we get back together? Can we in this new life of working home, working at work, you know, at some point, can we actually grow like we used to, even though we didn't have a lot of great growth to begin with? But does that mean that we are permanently at a lower growth rate in the economy? And it's just something I think about. I don't really have an answer for you on that one, but it's just something that I kind of just say, we have to see how it all plays out. And I think that's what the Fed at the end of the day is going to do as well. It's let's see. We just implemented a ton of policy in place, and we're not going to be so quick to remove it. We'll see how it goes, and it's going to be data point by data point.
And to add on to that, just, I think if you look at, you talked about earlier, Steph, wages. If we're all working from home and we have a lot of additional flexibility, does that mean we don't have to increase wages? Our rent's not going to increase because, there's going to be less demand for a large scale office space. What is a change in the pass through as that is part of the 2017 Tax Act? How does that affect real estate investors? All of that could actually create downward pressure on that inflationary basket. And so how does that then translate into, how the Fed reacts? So there's so many changes that this environment, I agree with you. I think that efficacy of this vaccine, even if we get one in Q4, they're talking maybe 60 to 70%. Yeah. And it's, hasn't been proven in a lot of large scale trials. So I think there are reasons for people to be hesitant about taking it. And clearly, if you look at the science, there's a lot that backs up the fact that the coronavirus is not, even though it's novel, it's not all that unique versus other diseases that have been studied previously. So I think the expectations is that we will have a vaccine, but does that really change the fact that, workers have enjoyed not necessarily commuting 2 hours or have relocated outside of major cities because because their job is no longer going to be an in-person job on a regular basis. So I think that that has impacts on productivity. It has impacts on inflation. It has impacts on, what you need to put together as a benefit basket for a new employee. I can offer you all this flexibility and this really nice new computer that I just purchased from Dell, and we had to buy 5,000 of them. There's so many things that are factored into that. And so I think it's also, I think we always think about risk. And I know the title of this webinar was about risk, but there's always opportunity on the other side of risk. And you might have to get a little bit more creative or have a longer term time horizon, but this is a great time to be thinking about how do you see the world changing over the next 5 to 10 years? And I think technology as part of every sector, industry, sub-industry is, it's coming, and finding ways to take advantage of that without potentially paying nosebleed valuations is a great place to be right now.
I personally wish that Veridesk was a public company, because I feel like everybody has a Veridesk or some sort of version of one, right? So yeah, I agree with you 100%. I think you have to think, that's one of the reasons why I think technology has done so well, and it's 26% now of the S&P 500 in terms of weighting, and that's at the high end of its historical range. Yeah. But that's because tech is going into everything. John Deere was talking about how this technology that they're using, Honeywell, Caterpillar. These are companies that you wouldn't necessarily think, oh, you know what, they're taking advantage of technology. Yeah, sure, they're using it, but no, actually, they're seeing productivity and margin enhancement because of it. So every industry is using technology, and that's why it's such a powerful sector. Again, I know you mentioned the valuations. You got to be careful. You got to be prudent. You got to do your homework. But at the end of the day, I think that technology is certainly something that you want to have a large percentage in your portfolio for the very long term, because we're just at the beginning. We're just at the tip of the iceberg, I think, in this whole stay-at-home connectivity. And that whole thing, communication in general, we don't even know what's out there. It's gonna be fun to see.
Thank you, and exactly, segueing into my next question, and I think probably our final question, since we've got 2 minutes left. If I may, taking the challenging world that we're in into account, could you give me your top 3 sectors and your top stock picks right now?
Oh my gosh, put us on the spot, huh?
Yeah, that's kind of tough.
Well, I think that I think housing has structurally changed. I do get nervous about city real estate and city exposure. I think the burbs, I live out in the burbs of New Jersey, and I tease my husband, we should actually sell right now because the prices are going through the roof because people are migrating out of the cities into the burbs. Does that continue forever? I don't know, but I do know that interest rates being lower for longer will be certainly a benefit for the consumer and also for housing, and housing has been absolutely on fire. I've never seen existing home sales up 20% in my life. It was a record number, just a huge, huge number. number. Mortgage applications up 39% in the last week, and that was after 54% growth the week before. So I think that's a trend that will continue. Clearly, if rates go higher, you might see a pullback, but I think housing is certainly one. I think autos, we're seeing a recovery in the auto cycle. Some global trade numbers, you're seeing light vehicle sales globally up 73 million SAR. That's up from 45 million SAR in March. So you're starting to see a recovery. China's back to flat year over year in terms of auto sales. So I think, and going to technology, I own this little company called Aptiv. It's a technology company inside the car, and they make connectivity things for inside the vehicle and safety measures and that sort of thing. Their margins are going through the roof. So I think you want to have definitely exposure there as well. And I'm not ruling out the consumer. I know everybody wants to say the consumer is dead. I don't even see it anywhere. I mean, I know that they're being helped by the stimulus package. I believe you're going to get another stimulus package. I believe in the consumer. They're going to spend. And when I see retail sales growing 7, 8, 9, 10%, that tells me that there's still interest out there to buy. So those are the three sectors. I will refrain on stock ideas.
Yeah, I would just say, I think enterprise spend on technology is going to continue. So companies that are benefiting from enterprise spend, I think you're going to see not just large companies, but small and mid-sized companies believe that technology spend makes sense. We like the idea of healthcare technology. And so ways to make, medical records online, better ways to deliver procedures that require less human intervention, telehealth, a little expensive right now, but the large, you can actually get exposure to that through some of the larger companies. So look into that. If you look under the surface, they have their own telehealth platforms, and then the kind of the resurgence in industrials and smart industrials, as I mentioned, industrial companies that are integrating technology, that are creating real just-in-time inventory management and being able to work directly with their end consumers to determine exactly what they need and when. It helps them from an inventory perspective. It lowers their long-term costs, but also continues to create competitive markets for them internationally. So,
thank you. I had some more questions, but we've got to end here. I just want to say this was a lot of fun for me. I hope it was for you and for everybody watching as well. And hopefully I'll see you both I'll virtually see you both at the Investment Summit in December, and we can discuss that further. And in the meantime, thank you everybody for watching today. I hope you learned something, and I wish you all the best. Stephanie, Shannon, thank you so much.
Thank you.
This was a lot of fun, as I mentioned, and I'll be in touch very soon.
Thanks so much. Stay well.
Thank you, and you.